HIMS and HERS recently released their third quarter 2024 earnings, and the stock found itself up 50% in just a matter of days, only to be sent crashing back down by some potentially bad news that could affect the fundamentals of the company. At least, that's what it seems like from the outside. And so in this video, we take a deeper dive into their earnings. We talk about some of the things I liked, some of the things that I actually found concerning, and whether or not their results actually justified the rally. And at the same time, we also want to look at some of these potentially bad news that could affect HIMS and HERS as a company, and whether or not that as well justified its subsequent crash downwards. Because if these catalysts aren't actually as bad as they seem, then HIMS and HERS could potentially be set up for a great run in 2025. But as always, potential is a dangerous word, so let's dive in. Now, for those of you who haven't watched my first HIMS and HERS video, I'm going to leave the link up here below. Basically, I break down in a little bit more detail what the company does. But on a very high level, HIMS and HERS basically aim to disrupt the healthcare system starting in the United States. Now, the healthcare market is a huge market. It's about a $4 trillion market altogether. Now, of course, that sounds very fancy. It sounds very big, like there's huge potential for growth. However, the truth is, I don't think that they can disrupt the entire market. But this is why I like investing in companies that go after a huge total addressable market. Because all you need is just a small slice of the pie for the company to do well. So to them, the current healthcare system is expensive, is inaccessible, and inconvenient at the same time. And so what they actually hope to do is to digitize the healthcare system and make it so that it is affordable, accessible, and convenient for the customers. And so with that, let's talk about their third quarter earnings. Now, what I do like about their earnings, right, is I want you to take a look at this graph over here. You can actually see very, very strong overall revenue growth. Now, I think this is where some concerns that people have start to arise, because if you take out the most recent quarter, what you actually see is that revenue trends have actually started to decline. There's actually a step down in terms of the growth rates that we actually see from this company. Previously, they were growing at around 80 to 90% year over year. In the last couple of quarters, they actually grew at a 40 to 50% year over year range. Now, this is objectively still fantastic growth rates, but the concern obviously is that growth is over time starting to slow down. And I guess the concern here is that there's a sudden boost now back to the 70% growth rates, and whether or not this is solely down to the GLP-1 compounded product driving growth. Now, if you are not sure what this whole GLP-1 is, what's the whole hoo-ha about this, I basically spoke more about this in my first video, which I'm going to link over here and down in the description below. But I guess the worry is that once GLP-1 is being taken off the FDA shortage list, there will be a sharp decline in revenue growth for HIMS and HERS, and all of this is just basically papering over the cracks and that their company actually in decline. Now, later on, I'll touch on what management actually has to say about this, but I think I just want to put things into perspective that actually a 40 to 50% growth rates is actually still pretty insane. And I guess it's actually quite normal when we are investing in growing companies that as the revenue number starts to grow, it becomes bigger, right? It's normal that we see growth start to slow down, right? It's just the law of large numbers. And so to me, whether or not this is a longer term boost or whether or not this is a short term boost isn't important in the long run. Because I guess more importantly to me is that we understand the business model of the company. They actually own manufacturing facilities. Yes, they do produce drugs, but they're actually not a pharmaceutical company, right? Or at least they're not a typical pharmaceutical company. Now, HIMS and HERS is actually a platform business, and what this means is that every new product, every new vertical that they add into their current offering is basically a new way for them to serve their new and existing customers. And so how this works is that basically as people come onto their platform, right, HIMS and HERS basically collects their data, and they already have data for millions and millions of customers. And what they're able to do is to examine this data, analyze this data, and basically cross-sell a product that is suitable for the new member. And so perhaps as investors, this is something that we just have to model into the business, or in a sense adjust our expectations, that each time that they open up a new vertical or basically introduce a new product into their ecosystem, we might be seeing short to medium term boost in revenue that can last a couple of quarters, but basically not to lose sight on the business fundamentals, what actually tells us how well the business is growing. As long as their long-term growth trend is on track, business fundamentals like the number of subscribers and the percentage of subscribers that are on personalized healthcare solutions. As long as these numbers are increasing in a healthy rate, then we know that the company is in a good place. Right, now if you take a look at the breakdown of the revenue mix, you can also see that in terms of their quarterly revenue, over 90% actually comes from online revenue. And if you look at how they define online revenue, they actually say that this represents sales of products and services on their platform, net of refunds and chargebacks. Now, they actually tell us that, their online revenue, like I said, consists of products and services purchased by customers directly through their online platform. However, the majority of their online revenue is subscription-based, where customers agreed to be billed on a recurring basis to have products and services automatically delivered to them. And that is the core thesis for HIMS and HERS and what makes them stand apart from other pharmaceutical companies. Additionally, this small bar that you can see at the top over here basically represents their wholesale revenue, and this is actually revenue generated when they sell their products to wholesalers. So I believe this is because they actually do offer some white label products. Now you can see over the last 5 years, they actually also grew member count from 200,000 members to over 2 million. That is a 10x in 5 years in terms of their member growth. Because if you take a look at this graph, what you will notice is that not only is the total number of subscribers increasing, which is represented by the blue bars, the red line is also increasing, which actually represents the pace of addition of new members onto their platform. That is increasing as well. Now, however, actually this comes in later on in the video as one of the problems that the company actually face, how they're actually getting all this growth. Now, the next graph actually also looks very nice because you can see the trend of total subscribers is the same as before, right? Increasing over time, which is the blue bars. And we actually see this other metric called the net order. So the company defines net orders as the number of online customer orders, net of refunds and chargebacks. So this is not a revenue number. This is not a dollar amount. This is actually the number of orders. And so what we have actually done, or what I've actually done, is to take the total number of net orders and divide it by the number of subscribers that they have to see the number of net orders per subscriber. And we can actually see this number, although it is declining over the last couple of years, it is still above 1 right now, which basically tells us that existing customers are continuing to order from the platform. And so if you're looking at this, you might be thinking that hey, this is actually quite concerning, right? The net orders per subscribers dropped from 2.5% to 1.3%. I think this is actually a perfectly reasonable scenario considering that they have grown their customer count at a 57% CAGR over the last 5 years and basically 10x their total subscribers count. Because for those of you who have followed me covering so far, I guess the same understanding is being applied here. As the company grows its subscribers, right, it's going to take time to cross-sell and expand adoption of their products across the entire member base, especially if the rate of growth of subscribers is as fast as we are seeing over here. So let's talk about the actual earnings call. Now, I think firstly, you can see from management's comments that the long-term strategy is not in any one particular drug that they are manufacturing or one particular condition that they want to focus on treating. Because when talking about the GLP-1, they are not just measuring the take rate of their GLP-1 compounded product, but the retention of each cohort of customers. So they actually tell us, right, that after 4 weeks, 85% of the customers are still interacting with their platform. And after an entire quarter, which is 12 weeks, 70% of them still continue with their subscriptions. Hi, this is post-production Elijah here speaking, and I'm basically jumping in because I realized I forgot to add this additional point during the main recording. Now, one of the reasons why I'm actually talking about the retention of patients or customers on their platform, right, is because during the earnings call, they actually compared their compounded GLP-1 product and its retention rate to the normal GLP-1s that customers tend to use. And in the normal GLP-1s, they actually see retention rates of less than 70% after 4 weeks. And that number actually falls to around, I think, 42% after 12 weeks. So that is in comparison with their 85% and 75%. And so the reasons for this lack of retention in the normal GLP-1 products, a lot of the reasons cited tend to be due to side effects and less than desired frequency of engagement with the providers. So this is why perhaps HIMS is managing to keep a larger portion of customers onto their platform because they give a more holistic form of care. And I think that it itself is supporting the thesis that HIMS is a platform-based business and not a products-based business. So I think as an investor, it's important for us to be aligned with the strategy that management has for the business at that point in time. Of course, strategy does change over time. And so as investors, that's what we have to do. We have to keep up with what management is doing and not go off and measure our own metrics, right? So because from my point of view, how I actually see this is that currently, I think the focus on management is actually to grow their subscription base and to basically retain as many new subscribers as possible. And over time, as they add more and more products to their existing offering onto their platform, it basically gives them the ability further down the line to monetize all these subscribers that they have. So when I think about the pharmaceutical space, there always seems to be a lot of like back and forth with the big companies. And I think it is definitely in the best interest of all these big companies, right, that they keep harping on the narrative that, the shortage of GLP-1 is being resolved, because it keeps people away from the compounded version, right? If the actual, the real branded drug is coming back onto the market, then perhaps some people are less likely to use the compounded version. But what I particularly like is that during these earnings, HIMS actually reported their own numbers that they did research on. So they actually told us that in the last 2 months, over 80,000 reports came in through their platform, basically from consumers who are unable to obtain these GLP-1 treatments, the branded GLP-1 treatments. And so they actually have the statistics to back it up, which I actually find quite interesting and quite cool. And they basically released their own studies where they talk about the same thing, right? And they introduced this GLP-1 supply tracker, and individuals can actually, go onto their platform, voice their frustrations and their concerns. And so basically what HIMS does is basically they make this information, they make all these statistics available to the FDA so that, the FDA actually has the information it needs to support accessible care. And I really like this because, in my previous video, I was talking about how there could be certain legal ramifications if they continue to go down this line. So I really do like it that they are, well equipped with their own research and they can actually back it up with actual numbers, and they are equipped with their own studies and things like that. Of course, some people might say that, they can be just faking all these numbers and fudging all these numbers. But I guess if you're providing the numbers and the statistics to the FDA to justify the production of, the compounded GLP-1 products, I think it's very unlikely that they would actually risk the wrath of the FDA by being fraudulent in their numbers, especially considering the fact that, I mean, listening to the management and things like that, they do hope to operate in this space in the many, many years to come. So if you listen to, management's overall take on this whole GLP-1 issue, you can actually see that, the production of the compounded GLP-1 is just one part of an overall strategy to target weight loss. And with patents expiring soon, this is not going to be an issue for much longer. And basically this brings me to another point, which is that, HIMS and HERS, their strategy is they're essentially a platform business, like I've been saying many times throughout this video. And what they have done is that they have actually ventured into the nutrition market as well. And this will be additive to the overall thesis and additive to their revenue as well, because this actually really shows us that they are a platform business and they are not a products-based business. And I think you can see over here, right, they're not actually targeting a specific drug in the market for weight loss, but they're targeting weight loss as an issue by itself. And so offering a holistic solution to our customers. It says here that the HIMS and HERS customers will now be able to supplement their treatment plan with daily meal replacement bars and shakes to support them in their comprehensive weight loss journey. So they're not only providing the medication that you need for your weight loss journey, but they're actually also helping you curate treatment plans and meal plans and things like that. It says HIMS and HERS is elevating its offering to supplement the comprehensive, individualized weight management plan designed by doctors that take every aspect of the customer's health into account. And so I think what we're actually seeing here is the whole thesis of HIMS and HERS being played out as they build out this weight loss vertical. Right, and I think this, you can actually extrapolate the effects and the way that they're actually going about doing this to look at the other verticals that they have in terms of mental health, hair loss, and things like that, and how they can actually build out all these verticals and offer a more holistic form of support beyond just medication to the customers. Now, this is something important for us to keep in mind as we approach the next discussion point, something that I call the Amazon problem. Now, I think by and large, right, despite some of the negative takes that some of these bearish analysts have around HIMS and HERS as a company, I think the market really liked what it saw from their third quarter earnings, which basically is the reason why the stock price went up 50%, right, over the next couple of days after they released their earnings. However, I think, the subsequent 35% drop in their share price was actually quite surprising to me. I think the reason behind the drop is actually quite surprising to me, because the reason for this drop is actually Amazon entering into the telehealth space. And it's not so much the drop that actually surprised me, but the magnitude of the negative reaction, because to me, this is not something that is new. And I think for me, this is where, earlier on, I basically talked about how HIMS and HERS can differentiate themselves by focusing on holistic solutions and treating, the condition in its entirety. Being a platform-focused company rather than a product-focused company is basically something that can actually protect them from the competition. Now, I think we have to understand the nuances in approach and basically accept that there's possibly going to be an overlapping in terms of the customer base. But I think over the long term, how I actually see this, Amazon entering into the telehealth space is basically two companies within the same space targeting slightly different demographics with slightly differentiated strategies. And I guess the thing we have to understand about markets, right, is that if there's money to be made, people will always come, competition will always come. So as investors, we cannot just jump to the conclusion that, because there is competition, right, then the company that we are investing in is definitely, going to fail. Because look at Apple with Apple Music. I think a lot of people thought that, Apple Music would take Spotify's lunch, but that didn't happen, right? And I think the reason for that is that, many of these big companies, when they actually expand into a new arm of business, right, that's basically what it is. It's just one arm in a humongous business. So their focus is basically not as sharp as companies like Spotify, or in this case, HIMS and HERS. Because HIMS is basically a smaller company, they are able to be more focused in their approach. They are able to differentiate themselves more in terms of what they offer to the customers. And they're basically a more nimble, more innovative company. And because this is their entire business, it really gives them the edge when they compete with big companies. And so I think what you can see here is that the edge that HIMS and HERS have over Amazon is their personalized solution. If you take a look at this graph over here, you can see that this is actually the first quarter, right, where we actually see the number of subscribers utilizing a personalized product cross the 50% mark of total subscribers, and this makes their product incredibly sticky. I think these 50% of subscribers that actually use their personalized product are customers that are looking for a more long-term solution, and they probably require a more long-term treatment plan, which is why they want to personalize the type of medication that they are receiving, right, in terms of the dosage and the form factors. Because as a consumer, if I think about it, if this is something that I'm only going to be taking for, a couple of months, 1 to 2 months, then I might not see the need to actually incur additional cost to personalize the medication for me and just go for the cheapest medicine out there, which is where Amazon comes in, right? I think Amazon basically will try and focus on making some of these drugs affordable. And when you consider some of HIM's customers that are from less affluent backgrounds, perhaps this is where some of the overlap will happen with customers who are on, shorter term treatment plans may decide to use Amazon's service instead. But I think as they get more customers and more customers onto their personalized subscription plan, the wider their moat becomes. Because if you're fighting based on revenue, then of course, Amazon has, money to burn, so they're able to take it in the margin and to basically, offer a lower price than you. But if you're HIMS and HERS and you're approaching this from a different angle using a personalized solution approach, then this makes your offering a lot more sticky than what Amazon has to offer. And I would dare say that the customer that is using their personalized product is way less likely to go over to, a platform like Amazon, even though there might be some cost reductions over there. I guess you can compare this a little bit to buying a computer. I think we all know, if you go to your local hardware store and things like that. Actually in Singapore, we have this entire building in our city center dedicated to selling spare parts for computers. And I know friends who actually go there, buy the parts and build their own supercomputers for $1,000 or less. However, although that is definitely the cheaper alternative, I have no inclination to do that. I would rather spend time doing other things, and so because of that, I pay for a computer that has already been put together, even though it costs me more. So if I were to transfer this understanding into the context about HIMS and HERS and Amazon, yes, perhaps I can do my own personalization of my plan. Perhaps I can do my own management of the drugs that I take and things like that, and find cheaper alternative of each of the medication I need on Amazon's platform. But I think it becomes hard to keep track of when you have a bunch of medicine to take at different timeline on different dosages and things like that. But I think with HIMS, because they are able to combine everything for you into a one form factor, either a pill or a liquid or a gel or something like that, plus the fact that they actually offer external support beyond medication, I think this is why certain consumers would then prefer to stay with HIMS and HERS. And this is why it's important to invest in companies that are going after a huge total addressable market, because there will be a place for everyone. I think Amazon entering into this space is not actually a huge concern. I think the concern for me will come if Amazon starts to acquire pharmacies and starts to compound their own drugs and things like that, and to compete on that front to try and become a telehealth platform as well. But as long as they're just basically offering telehealth consultations and the ability for consumers to buy their own medication and things like that, I think they're serving the same market, but perhaps slightly different demographics. And I think in the long run, both of these companies can do well at the same time in this market. And so let's take a look at valuation. And the first thing you have to take a look at is the like and subscribe button down below. Now, don't just look at it, hit it, smash it, and thank you for your time. Now, back to the video. Now, so when it comes to valuation, let's understand some of the numbers first. And I think I want to take this time to actually bring up one of the issues I actually have with this company, which is their marketing spend. You can see that every single quarter, they tend to spend over 50% of their revenue on marketing. Now, that is a huge percentage of their revenue to actually allocate into marketing. And this was initially why I was holding off investing in this company, because I wasn't sure whether the growth was organic or was it, simply driven by the amount of money that they pumped into marketing. And they're actually one of these companies that, after they stop spending in marketing, they actually, will see growth fall flat on its face. Now, to me, why this was a concern is because I see scalable business as one that, even as they cut back on marketing, the number of customers actually still continues to grow and manage to maintain its pace, or at the very worst, decline at a significantly slower pace than at whatever pace that you're cutting your marketing. Because this actually shows me that the consumers basically really like your products and services, and even without you spending on marketing, they're coming back for more. Now, despite my concerns about marketing, one of the things I really like about this company is how it manages its sales, general and admin expenses. I think this fell from 61% of revenue all the way back in the second quarter of 2021 down to just being around 23% of revenue. And so that's exactly what we want to see, right? Expenses coming down while profits are going up. And so, like I said, the only so-called blemish left on this company is the marketing spend. But even that, as a percentage of revenue, is over time coming down. And there's one interesting metric that I want to talk about that basically shows us, that this is actually trending in the right direction. Because if you take a look at this graph over here, even back in 2020, they were spending huge amount of their revenue on marketing, right? And this percentage has always been high historically. Now, this actually peaked at around 60% of revenue back in the first quarter of 2022. But I think over time, they were able to maintain, the percentage of marketing spend while, at the same time accelerating the pace of member growth. Now, at the start of this year, we finally see an inflection point, because marketing spend as a percentage of revenue started to decline. It was 51% in the fourth quarter of 2023, down to now just 45% of overall revenue in the most recent quarter. Now, yet during this time, the number of subscribers basically was still increasing at a healthy pace. And so to me, the growth story still seems intact. Now, I think for one, do understand the concerns that people have regarding the GLP-1 and how, it can be papering over the cracks and perhaps, it's actually skewing the growth numbers and things like that. Now, I think if we want to talk about how GLP-1 will affect the valuation of the company, I think it deserves a whole video by itself to slowly model out. But I think right now what we're doing is looking at it at a high level. We can actually see that the company actually tells us that, excluding GLP-1, subscriber basically grew by around 40%. Now, if you take a look at the actual results that were reported, total number of subscriber counts with GLP-1 basically grew by 44%. And so that means, the GLP-1 basically only accounted for about 10% of overall subscriber growth. So in this valuation, I think the assumption that we're going to use is that the GLP-1 does perhaps, might have an impact on revenue, but no more than a 10 to 13% impact on revenue. Now, I didn't pull this 10 to 13% number out of thin air, right? Earlier on, we actually found out that the net order per member stands at around 1.3 currently. So if we lose 10% of subscribers, now if each subscriber uses one product, that's going to be a 10% hit into the number of products that are being used, which is then correlated to a 10% hit in revenue. Similarly, right now, because the net order per subscriber stands at 1.3, so that will make a 13% drop in net order, and then we correlate that to revenue to get a 13% drop in revenue, right? So that's where we get this assumption from. It's a very high level assumption, but at least I'm just putting it out there. So apart from this, I think research and development is an area that they have managed the cost quite well. That has always been trending between 5 to 8% of revenue. I think there were 2 quarters in between where I really couldn't find the R&D spend, but I think generally you can see, especially in the last couple of quarters, the amount of research and development spend has been between 5 to 6%. So it's been quite a consistent level over here. Now, if you take a look at this graph over here, provided in their third quarter earnings, you can see the net cash generated by operating activities is increasing at a very rapid pace. Now, the thing is, right, this company, HIMS and Hers, is nowhere near optimized for free cash flow. Although it is generating free cash flow, but that is because, the management is growing in a very sustainable way. So what we'll do, we'll just try our best to use this and project out its future valuation, at least in the short to medium term. Because when the company is not yet fully optimized for free cash flow, at best we're just guessing where it will level out in the long run. Now, on top of this, I've actually found that the WACC for HIMS and Hers, often referred to also as the required rate of return, is around 8%. But I want to use the 10% for this valuation simply because this is a more volatile investment, and so this 10% basically gives me a little bit of a buffer. And I'm also going to use a 3% terminal growth rate, which assumes that after 2028, they will only grow at 3%. Again, like I said, for the nature of this company, this is not a realistic expectation, but since they are generating free cash flow, I thought it would be interesting to compare this result with the result of their valuation using a PE ratio. Right, so they also have a cash position of around $254 million. And of the most recent quarter, they have about 235 million shares outstanding. So for the full year of 2024, they actually projected 1.465 billion of revenue. Now, despite the fact that they tend to beat their own projections, we're not going to take that into consideration when we do our valuation. And basically what we're going to do is that moving forward, we're just going to use the analyst estimates that you see over here as our growth rates for the next couple of years. So at the same time, in terms of the cash flow margins, we assume that they stay the same. Currently, it stands at around 17.9%. So we assume that moving forward, over the next few years, that doesn't expand. It stays at around 17%. And capex of around 2%, which is, fairly consistent. That gives you an implied value of around $27.23. Again, this is why I tend to say that I don't really like to use DCF because of its limitations, and it just, makes this whole valuation process become a math equation, especially when I'm looking at growing companies. Because I think without looking at metrics like, revenue per subscriber, net order per subscriber, and things like that, it's quite hard to project out revenue. And whatever we are doing, or when we are just using these analyst estimates, right, is basically just putting numbers into the DCF. So it's basically just our best guess. And as I'm saying this, I'm just trying to be aware of my own biases as I go through the valuation model. Now, if you take a look at revenue growth in the most recent quarter, it actually came in at 77% year over year. Now, you assume that 10% of this actually comes from the GLP-1. Now, even if you say, 20%, right, comes from GLP-1, that still puts the growth at 61% year over year. Now, in fact, right now, currently they're actually on track to deliver a 74% year-over-year growth on an annual basis, right? And so I'm not sure, if we'll see such a big drop off in terms of growth rates, because I think analysts are expecting growth to be around 39-38% next year. So if you keep the margin profile the same, and you just, assume that revenue growth basically steps down from 50% next year to 40%, 30% and 20%. So it basically steps down from 50 to 20% every single year. You end up with an implied price of $36.22. But like I said, I do have some reservations when it comes to using DCF to conduct valuation for HIMS. So I'm going to be using the P ratio as well and see how the valuation stacks up against one another. I basically wanted to compare them to Teladoc initially, but because Teladoc is still not profitable, I couldn't get a PE ratio, so I ended up deciding to compare them with Eli Lilly and Novo Nordisk. And so Eli Lilly is trading at around 80 times PE and Novo Nordisk at around 30 times PE. And so on average, the PE ratio here is around 55 times. Now, the assumption here is that the fourth quarter revenue is going to come in at around $420 million. That is a 70% year-over-year growth. Now, if you take this revenue and sum up the last 4 quarters, you end up with around $1.415 billion in revenue for the whole year. And if you take a look at management's guidance, right, the low end of the guidance actually comes in at $1.46 billion. So we can, assume that management actually thinks that revenue will come in higher than $420 million in the fourth quarter, but we are not going to go with that assumption. We're just going to use $420 million. Now, from here, we're going to assume that the net income margin profile stays the same, around 19%, which is what they did in the third quarter of this year. And with that, you get a net income of $79 million in the fourth quarter. If you add up the net income for the full year and divide it by the shares outstanding, you get an EPS of around 76 cents. Now, if you apply a 55 times PE to that, you get a price of around $42.07. So in essence, I guess if you think that the analysts are right, growth rates will start to halve next year and fall to a low 20% range and fall even further down to the mid-teens percent kind of range in the coming years, then currently the company is overvalued. And so using both the discounted cash flow and the PE ratio valuation, what you end up getting is an implied share price. If you take an average of the results of these two valuation models, you get an average share price of around $39.15. So, there's going to be so much more to cover with this company, how the GLP-1 is going to affect their growth trajectory, what does the new entry into the nutrient segment is going to do for them as a revenue driver. But I guess if you want a better idea of what this company actually does as you form your investment thesis, then I talk more about this in this video over here, and I'll see you in the next one.